The physical scale of automotive retail logistics requires immense capital. Thousands of vehicles traverse massive distribution pipelines every day to reach consumers. Looking at this tear sheet, Sonic Automotive commands a share price of $90.51, supported by $15.15 billion in 2025 top-line revenue. That revenue is generated across three distinct operational segments. The core franchise dealerships handle the bulk of the volume, supplemented by EchoPark's used vehicle operations and a growing footprint in the powersports sector. This operational base produces a profitable baseline, generating an adjusted diluted earnings per share of $6.60. Institutional investors looking at that single-digit growth rate struggle to reconcile it with the massive revenue footprint, resulting in the stock's moderate market multiples. A recent SEC 13D-A filing dramatically changes the context of that valuation. David Bruton Smith and the founding family now report beneficial ownership of 42.3% of the company. Because Sonic Automotive utilizes a dual-class capital structure, where Class B stock carries 10 votes to Class A's 1, the family controls the majority of the voting power while holding a minority of the total equity. This chart illustrates the mechanics of a creeping takeover. Over the last few years, aggressive corporate share repurchases have reduced the public float. As the company shrinks the total outstanding shares, the family's fixed equity block mechanically expands past that 42.3% threshold without them buying any new stock. Crossing this ownership threshold aligns with language in the filing. The family is openly considering alternatives, such as a leveraged buyout to take the company private. Sonic Automotive has moved into the realm of an asymmetric M&A arbitrage play. Evaluating the company strictly on business quality reveals a narrow economic moat. The automotive retail sector is cyclical, heavily dependent on consumer credit and vulnerable to supply shocks. Looking at the balance sheet, Sonic carries a net debt to adjusted EBITDA ratio of 2.17. That leverage limits capital flexibility and increases risk during a macroeconomic downturn. Analysts project roughly $120 million in annual free cash flow for 2026. Divided across 31.6 million outstanding shares, the company generates $3.79 in free cash flow per share. Buying at the current $90.51 price secures an implied owner earnings yield of exactly 4.1%. A 4.1% yield lacks a sufficient margin of safety for a capital-intensive, cyclical business. To justify a value-oriented entry, the market price would need to drop to roughly $50. Under Peter Lynch's categorization methodology, Sonic qualifies as a slow-growth stalwart that contains a hidden turnaround segment within its operations. That turnaround candidate is EchoPark. Following heavy previous investments, the company recently raised 2026 guidance, projecting EchoPark's adjusted EBITDA to hit $35 to $40 million. However, dividing the current price by the $6.60 earnings per share yields a 13.7 PE ratio. Paying nearly 14 times earnings for a business with stagnant revenue growth makes the stock unattractive as a pure growth play. But the analysis pivots when dealing with an asset or catalyst play. Extreme insider concentration, combined with a shrinking institutional float, forces the market to price in the probability of a buyout. That 42.3% insider consolidation creates an immediate catalyst, transforming a stagnant retail stock into a viable speculative hold. Benjamin Graham's defensive investing checklist requires adequate revenue size, earning stability, and a moderate price-to-earnings ratio. Sonic passes the revenue and earnings tests, but falters on price. This displays Graham's formula for calculating a stock's intrinsic value. We insert the $6.60 earnings per share and estimated $40 book value per share into the variables. The math resolves to a final intrinsic value of $77.07, well below the current $90.51 market price. Trading at a premium to its Graham intrinsic value, the stock offers zero margin of safety. Shifting to modern institutional valuation, we initiate a discounted cash flow model using that projected $120 million in annual free cash flow. For the baseline assumptions, we apply a 9% weighted average cost of capital and a conservative 2% terminal growth rate. This table executes the perpetuity growth math, modeling cash flows forward to resolve a strict implied equity value of $54.24 per share. Shifting cost of capital and terminal growth rates creates a sensitivity heat map, where perceived fair value swings from $42.22 to $75.94. Because the company is an active buyout target, an enterprise value to EBITDA multiple often reflects market realities better than a strict cash flow model. We take the $560 million projected 2026 EBITDA and apply a standard 7x multiple, which aligns with industry averages for automotive retail. This horizontal bridge chart calculates the enterprise value. We subtract the estimated $1.215 billion in net debt to isolate the residual implied equity value. That equity is divided by 31.6 million outstanding shares, yielding a final EV to EBITDA value of $85.60 per share. Even these aggressive modern valuation models fail to justify the current $90.51 price point. The market is pricing in an external premium. This consolidated summary table aligns the three valuation outputs: the $77.07 gram value, the $54.24 DCF, and the $85.60 multiple all sit below the actual market price. The baseline valuation is protected by massive total revenue and stabilizing gross profits per unit within the EcoPark division, but those strengths are countered by high operational leverage and the looming threat of vehicle tariffs restricting consumer demand and pricing. The delta between the fundamental models and the $90.51 market price represents the take-private premium currently priced into the stock. The Smith family's 42.3% ownership acts as a synthetic floor, preventing the stock price from collapsing down to its true discounted cash flow value. The institutional verdict on Sonic Automotive is a firm hold. That rating exists due to the M&A catalyst, not because of fundamental value. Executing a short position on overvalued shares is highly dangerous when insider concentration is this severe. A sudden buyout announcement would immediately crush short sellers. This readout defines the actual safety zone. Legacy models and DCF calculations converge to create a true buy signal between $50 and $55. In modern value investing, understanding capital allocation mechanics and corporate governance often overrides pure cash flow metrics. The math tells you what a company is worth, but the ownership structure dictates how the market actually prices it.